In market news this week, we saw the kickoff to India's 5-week election program. Gold hit a bull run, and world finance leaders gathered in Washington to prepare for this weekend's IMF spring meetings. I'm Nassie MacDonald, and you're watching the weekly wrap-up. My guest on the line now is Chris Weston of IG. Chris, stock market gains following Wednesday's Fed meeting minutes have been well and truly erased, as the Nasdaq experienced its worst day since 2011 in Thursday's trading. Given Wednesday's broadly positive outlook, what continues to prompt concerns over these momentum names? Uncertainty regarding high flyers such as Netflix and TripAdvisor already acted to soften market response to last week's upbeat NFP data.
The way I see things going, I think that if you actually look at these names, this hasn't been a one-week affair. The issue has been that beginning of this week, we actually saw the Nasdaq trade through and close below the 2013 uptrend, and I think that caused a lot of people to really sort of wake up and look. People who hadn't been involved in these names, the high growth, high momentum, and very, very high PE names, and I think that's when it came on everyone's radars. That's when the press really started recording it, and that's when we saw the big volatility coming through. If you actually look at things like Twitter, for example, it has actually been falling since the back end of last year, and everyone talking about the lockup and all the shares that are going to come onto the market. So I don't think this has been a one-day affair. I think what's actually happened is while the market had this really big consensus trade coming through, that the Fed were completely behind the market. We were seeing 80 billion of liquidity being printed every month, and with such low growth in the US economy, a lot of that money fed straight into the stock market. So everyone was happy to buy these names, these concept ideas, and ultimately what happened, I think, in the last couple of weeks, everyone sort of realise that the Fed aren't going to be there anymore. They're not going to be there probably from around October time, because we know the hurdles and the barriers to tapering the taper program are very, very high. So it's a question. I think what we saw is a few funds taking profits on these names, and that's really sort of snowballed there. And I think it's really interesting to see what we're seeing at the moment in the markets. It's the first time in a long time that we're seeing the markets coming under pressure predominantly on a valuation basis. We've seen big sell-offs before, we've seen corrections and even other bear markets in developed markets, but it's all been driven by geopolitical issues, macro concerns. This is the first time in a long time that we've seen a big sell-off coming through predominantly based purely on valuations, and I think it's just a few funds taking profits. The technicals subsequently have looked bad, and other people therefore are just questioning what's next.
Good news for job seekers on Thursday, as Australian unemployment defied expectations, coming in at 5.8%. While this data is indicative that companies are investing in the Australian economy once again, business confidence continues to lag.
Well, I think the jobs numbers were good, and I think they were also pretty bad. Ultimately, if you look at price action in Australian dollar, we saw it trade up above the 94 handle, I think got to 94.40. But if you actually look at the quality of the numbers, they weren't brilliant. There was 22,000 full-time jobs lost. We saw 40-odd thousand part-time jobs, so the net number was obviously positive. And if you actually look at the unemployment rate, it dropped 30 basis points, but that was a predominantly reason down to the fact that the participation rate fell. It was good. The market liked it, but then ultimately the overall quality was not quite there. What we've actually seen in the Australian economy is actually good data. If you're looking globally in the developed markets, if you look in the G10 currency space, Australian data is holding up quite well. In fact, given that currencies are trading so much on the inflation bias at the moment, Australia is one which actually has inflation towards the top end of the central bank's range, and I think that's part of the reason why we've seen this huge positioning exercise, or should I say repositioning exercise, over the last month or so. And I think that's going to continue to see the good support coming through. The other thing, of course, is that the Japanese have been huge buyers of Australian government bonds of late, and that's, of course, a huge Australian dollar positive. Massive amounts of Australian buying in the last couple of months. Last 5 months, they bought over $6 billion worth of Aussie bonds, and I think that's another reason why we've seen that coming through. So the Australian economy is actually outperforming on a relative basis against a lot of the G10 region, and I think it's going to hold up quite well. So if you look at what's priced in, the market's pricing in about 20 basis points now over the coming 12 months. So one of the most hawkish stances from the swaps market out of any central bank there.
The Aussie dollar's rally was softened by China trade data also out on Thursday. An unexpected trade surplus was offset by poor import-export data. As Chinese officials state that they will not be employing short-term stimulus, do markets concur that this is simply temporary economic growth volatility?
I think so. I think if you look at the numbers themselves, they were mixed up by some situations which obviously they put in place throughout the last couple of months, where they were looking to curb speculation in the currency markets and the hot money inflows, and that did have ramifications on the export-import numbers there as well. So I think also it's worth knowing that these are year-on-year numbers, and the prior year was very, very strong, and they were buoyed up by some rather erratic numbers in the prior year. So I think that was, they were coming off a very, very high base, shall we say. So I think a culmination of those different factors, what the PBOC have been doing to curb intervention, the fact that we came off a very high year, means that people have probably given this a bit of a wide berth. They were disappointing numbers, and we got a surplus, which of course is good, but it came in a low quality environment. So I think what we've seen here is that it is a one-off. I think the officials within China have stipulated that's probably the case as well. And I think actually yesterday there was a bit of optimism coming through because of this agreement, this equity market agreement between the Hong Kong and Chinese regulators to be able to trade each other's shares more openly. So there was a bit of a euphoria coming through there. But ultimately, that number that we saw from the export number is a one-off, and I certainly wouldn't be looking to sell any risk assets based on that.
Chris, many thanks for your time today. That's all from me right now. Thanks for watching.